There is a number that should be sitting at the center of every serious conversation about American real estate right now. And almost nobody is talking about it. 16 million. That is the approximate number of vacant housing units currently sitting empty across the United States. 16 million homes. Not under construction. Not between tenants. Not being renovated. Simply vacant. Unoccupied. Generating no economic activity, no rental income, no contribution to the communities surrounding them. Just sitting there. And in a country where millions of would-be buyers cannot find affordable housing and millions of renters are being stretched to their financial breaking point, the existence of 16 million empty homes is not just a statistic. It is an indictment of how badly supply and demand have become misaligned in the current cycle. But here is what makes this number genuinely alarming rather than merely surprising. Those 16 million vacant units are not distributed evenly across the country. They are not spread proportionally across every city and every neighborhood in a way that dilutes their impact. They are concentrated, clustering in specific metros, specific zip codes, specific neighborhoods where the vacancy rate has crossed a threshold that real estate economists recognize as the point at which property values begin to deteriorate not gradually but in a self-reinforcing downward cycle. Here is something most people completely overlook. Vacancy does not damage property values linearly. One empty home on a street has minimal impact on surrounding values. 2 or 3 creates a measurable but modest effect. But when vacancy concentration in a neighborhood crosses approximately 8% of total housing stock, something shifts. The deterioration accelerates. Maintenance standards drop. Vandalism increases. Insurance costs rise for every surrounding property. And the perception of decline becomes a self-fulfilling prophecy as potential buyers begin avoiding the area entirely, which pushes vacancy higher, which accelerates the deterioration further. This is the vacancy spiral. And it is actively operating in more American cities right now than at any point since the aftermath of the previous crash cycle. I want you to hold on to something as we move through this breakdown. There is a specific mechanism that causes vacancy spirals to spread beyond their origin neighborhoods into surrounding areas that appear perfectly healthy on the surface. Most homeowners and investors in affected markets do not see it coming until it has already begun affecting their own property values. I will show you exactly how that spread mechanism works and how to identify whether your market is in its path. But first you need to understand why vacancy has reached these levels in the first place, because the causes in the current cycle are meaningfully different from what drove vacancy in previous downturns. The vacancy crisis of the previous crash era was primarily driven by foreclosure. Households defaulting on mortgages they could not afford, banks repossessing properties faster than they could resell them, entire subdivisions sitting half-finished as developers walked away from projects that no longer penciled out. That was vacancy born from credit failure. Sudden, dramatic, and concentrated in markets that had seen the most speculative construction and lending activity. Stop and consider how different the current vacancy picture looks. The vacancy accumulating in American cities right now is not primarily foreclosure-driven. It is accumulating through a combination of 4 distinct forces operating simultaneously. And understanding each of these forces is critical because they affect different types of properties in different types of markets, which means the risk profile is far more dispersed than the previous cycle and far harder to identify from headline data alone. The first force is investor oversupply in Sun Belt metros. The construction boom of the early part of this decade delivered tens of thousands of new units into markets like Phoenix, Austin, Dallas, and Atlanta at precisely the moment when the migration wave that was supposed to fill them began reversing. Remote workers returned to their origin cities. Corporate relocations slowed. And the population growth projections that developers used to justify their construction pipelines turned out to be significantly optimistic. The result is a category of brand-new, high-quality vacant units in markets that look prosperous on the surface but are carrying vacancy rates in specific submarkets that are already approaching that critical 8% threshold. The second force is demographic abandonment in legacy industrial cities. This is not a new phenomenon, but it has accelerated meaningfully in the current cycle. Cities across the Midwest and Northeast that have been losing working-age population for decades are now seeing that outmigration intensify as remote work and cost of living pressures push younger households towards smaller cities and suburban markets. The vacancy left behind in these cities is older, lower-quality housing stock that has no realistic prospect of reoccupation under current demographic trends. Here is something most people completely overlook. These two vacancy categories, brand new oversupplied Sun Belt units and aging abandoned Rust Belt stock, are creating completely different types of property value destruction in completely different markets. But they are both accelerating simultaneously in the current cycle. And the investors and homeowners caught in the path of either category are facing equity erosion that the headline stability of national average home prices is completely masking. The third and fourth forces driving current vacancy levels are where the story gets considerably more complex and considerably more consequential for homeowners who believe their markets are insulated from these pressures. Those two forces, and the specific cities where their combined effect is most advanced right now, are exactly where we are going next. Because the markets most at risk in the current cycle are not the ones most people are watching. The third force driving vacancy accumulation in the current cycle is one that almost no mainstream real estate commentary is addressing directly. And that omission is costing homeowners and investors in affected markets real money right now. It is the short-term rental collapse. Between the early part of this decade and the peak of the pandemic-era travel boom, the short-term rental market expanded at a pace that fundamentally altered the housing supply dynamics of hundreds of American cities. Platforms like Airbnb and VRBO made it financially rational for property owners to remove units from the long-term rental market and redirect them towards short-term vacation and business travelers. In markets like Nashville, Scottsdale, Austin, Savannah, and dozens of coastal and mountain resort destinations, the share of total housing stock operating as short-term rentals reached levels that would have seemed implausible a decade earlier. At peak, the numbers were staggering. In some Nashville zip codes, short-term rentals represented more than 12% of total available housing units. In parts of Scottsdale, the figure approached 15%. These were not marginal additions to local housing supply. They were structural withdrawals of inventory from the long-term market that artificially suppressed vacancy rates, inflated rental prices for remaining long-term units, and made local housing markets appear tighter and more supply-constrained than their underlying demographics actually justified. Stop and consider what happens when that supply comes back. The short-term rental market has been contracting sharply across most of these markets throughout the current cycle. The causes are layered. Municipal regulations in dozens of cities have restricted or effectively banned new short-term rental registrations. Insurance costs for short-term rental properties have risen dramatically. Platform saturation has compressed nightly rates and occupancy to the point where the yield premium over long-term rental no longer justifies the operational complexity. And the travel demand that sustained occupancy during the boom years has normalized, removing the exceptional revenue that made the short-term rental math work in the first place. Here is something most people completely overlook. When short-term rental properties convert back to long-term rentals or hit the sales market, they do not arrive gradually. They arrive in clusters. Because the financial pressure driving the conversion affects all operators in a given market at approximately the same time. The same regulatory change hits every short-term rental owner in a city simultaneously. The same insurance premium increase lands across the entire market at renewal. The same nightly rate compression affects every listing on the platform at once. The result is sudden clustered supply addition in markets that had been artificially supply constrained. And sudden clustered supply addition in a market that has simultaneously seen its demand drivers normalize is the structural setup for rapid vacancy rate increases and the property value deterioration that follows. I want you to hold on to something here that I will return to in detail shortly. The markets most exposed to short-term rental collapse are not the ones with the highest absolute vacancy rates right now. They are the ones where the conversion from short-term to long-term supply has not yet fully completed, where the supply is still in the pipeline, where the vacancy rate looks manageable today but the structural pressure driving it higher is already locked in. Identifying those markets before the vacancy rate crosses the critical threshold is the difference between protecting your equity position and watching it erode. But first, let us address the fourth force. Because this one affects markets that have no short-term rental exposure, no Sunbelt oversupply problem, and no legacy industrial decline. This one is hiding inside markets that most observers currently consider among the most stable and desirable in the country. It is the affordability-driven vacancy paradox. In a small but growing number of American cities, vacancy is rising not because there are too many homes and not enough people. It is rising because there are enough people but they cannot afford the homes that are available. The units are sitting empty not due to absence of demand, but due to a complete mismatch between the price point of available inventory and the financial capacity of the local renter and buyer pool. You might think this is a minor or localized phenomenon, but the reality is that it represents one of the most structurally dangerous forms of vacancy in the current cycle. Because it is vacancy that cannot be resolved by population growth. It cannot be resolved by job creation. It can only be resolved by price correction. And price correction, in markets where property owners have been conditioned by years of appreciation to expect values to move in only one direction, tends to arrive later and faster than anyone projects. Stop here because this is where the vacancy story intersects directly with the lock-in dynamic that is operating across the broader U.S. housing market right now. The homeowners who cannot sell without taking on a punishing new mortgage rate are the same. Homeowners whose properties would theoretically provide the affordable inventory that affordability-driven vacancy markets desperately need. If those locked-in owners could sell, they would add supply at price points that could actually clear in the current market. But they cannot sell without destroying their own financial position. So the supply stays frozen. The affordability gap persists. And the vacancy on the wrong side of the price divide continues to accumulate. This is what I was pointing toward earlier when I said the forces driving current vacancy are more complex and more dispersed than the previous cycle. The short-term rental collapse, the affordability vacancy paradox, and the lock-in effect are not separate problems operating independently. They are interconnected pressure systems reinforcing each other simultaneously across different layers of the same market. The specific American cities where these forces are most advanced, where the vacancy concentration is closest to or already past the critical threshold, and what the property value destruction looks like in practice for homeowners and investors caught inside these markets is exactly what we are breaking down next. Let us get specific. Because the vacancy crisis in the current cycle has a geographic fingerprint. And that fingerprint is more precise and more actionable than the broad national narrative suggests. The cities where empty homes are most actively destroying property values right now fall into three distinct categories. Understanding which category applies to a specific market tells you not just how bad the current damage is, but how much further the deterioration is likely to go before it stabilizes. And that trajectory information is what actually matters for equity protection and investment positioning. The first category is what economists are beginning to call the oversupply metros. These are the Sun Belt cities that absorbed the largest waves of construction activity between the early part of this decade and the present cycle. The markets where cranes dominated the skyline for years, where developers competed to deliver luxury units into a migration-driven demand story that has since significantly moderated. Phoenix sits at the center of this category. The numbers here are not ambiguous. The metro added more than 30,000 new apartment units in a single recent 12-month period. That is 30,000 units arriving into a market where net migration has slowed, where the corporate relocation pipeline that was supposed to fill them has thinned, and where the existing renter pool is already showing significant affordability strain. Vacancy rates in specific Phoenix submarkets, particularly in the East Valley corridors that saw the heaviest construction concentration, are approaching and in some cases exceeding that critical 8% threshold we identified earlier. Stop and consider what that means for the single-family homeowner in Chandler or Gilbert who has no intention of selling and no direct exposure to apartment market dynamics. Here is something most people completely overlook. Apartment vacancy in a metro does not stay contained within the apartment market. When vacancy rates in new construction rental buildings reach levels that force landlords to cut rents aggressively, those rent reductions ripple outward. Renters who were previously priced into home ownership recalculate. Why stretch to buy when you can rent a brand new unit with amenities at a price that has dropped 15% in 18 months? That demand withdrawal from the buyer pool puts downward pressure on entry-level home prices. And entry-level home price weakness eventually works its way up the value chain. Austin sits in this same category and in many ways represents the most advanced stage of the oversupply correction among major Sun Belt metros. The tech employment base that was supposed to be the permanent demand engine for Austin's housing market has contracted sharply. The companies that relocated headquarters and brought high-income workers into the market have since reduced headcount, reversed some relocations, and in several cases quietly reduced their Austin footprint entirely. The vacancy accumulating in Austin's luxury apartment towers is not the temporary between-tenant vacancy of a healthy market. It is structural vacancy born from a demand story that turned out to be less durable than the construction pipeline it inspired. Dallas and Atlanta are following the same trajectory, approximately 6 to 12 months behind Austin in cycle terms. The construction pipelines in both metros remain active even as the demand absorption that justified them has softened. This is the defining characteristic of the oversupply metro category. The supply keeps arriving after the demand signal has already weakened because construction timelines mean that projects green-lit during peak optimism cannot be stopped midway through delivery. Now let us move to the second category, which is where the property value destruction is most severe in absolute terms, even if it receives the least national attention. The legacy vacancy cities. These are the post-industrial metros across the Midwest and parts of the Northeast where population decline has been structurally embedded for decades but has accelerated meaningfully in the current cycle. Detroit, Cleveland, Baltimore, St. Louis, Memphis. These markets have vacancy rates that would be considered catastrophic in any Sun Belt context, but have become so normalized in local discourse that they barely register as news. Here is the number that reframes this entire category. Detroit's overall housing vacancy rate currently sits somewhere between 20 and 25% depending on the measurement methodology and the specific neighborhoods included. 1 in 4 housing units in significant portions of the city is sitting empty. That is not approaching the critical 8% threshold. That is more than triple it. And the property value destruction operating in these neighborhoods is not a future risk. It is a present and ongoing reality that has been compounding for years. You might think this category is irrelevant to investors and homeowners in more prosperous markets. But the reality is considerably more nuanced and considerably more concerning. The legacy vacancy cities are not static. They have cores of genuine revitalization, neighborhoods where investment and demographic change have created real value appreciation alongside the broader decline. But the boundary between the recovering core and the deteriorating periphery in these cities is not fixed. It moves. And it has been moving in the wrong direction in the current cycle as the affordability pressure squeezing lower-income households out of recovering neighborhoods pushes them into transitional areas that then tip toward the vacancy spiral dynamic. This is what I was building toward earlier when I described the spread mechanism that carries vacancy deterioration beyond its origin neighborhoods into surrounding areas that appear healthy on the surface. In legacy vacancy cities, that spread mechanism is not theoretical. It is observable in real time in the property transaction data of every major Midwestern metro. Stop here because the third category is the one that will surprise the most people watching this breakdown. Because it includes cities that appear on almost every list of desirable, high-demand, appreciating real estate markets published in the mainstream financial press. The third category is the affordability vacancy markets. And the cities in this group include names that will be genuinely unexpected. Miami, parts of Los Angeles, sections of New York's outer boroughs, specific submarkets within Boston and Seattle. These are not cities anyone associates with vacant homes or declining property values. They are cities that have been celebrated for their demand intensity, their supply constraints, and their long-term appreciation trajectories. And yet vacancy is rising in specific segments of these markets in ways that the headline price data is completely obscuring. Here is how it works in practice. Take Miami's condo market as the most advanced example of this dynamic currently visible in the data. Miami added significant luxury condo inventory over the past several years, targeting a buyer and renter pool of high net worth individuals, international buyers, and remote workers with above-average incomes. That pool has contracted. International buyers have pulled back due to currency dynamics, political uncertainty in origin countries, and growing concern about Florida's climate and insurance trajectory. Remote workers have partially returned to origin cities or dispersed to lower-cost alternatives. And the domestic high-income renter who was supposed to fill the gap has discovered that Miami's cost of living, when insurance, HOA fees, and special assessments are fully accounted for, no longer represents the value proposition it did 3 years ago. The result is vacancy accumulating at the top of Miami's market. Units sitting empty not because nobody wants to live in Miami, but because the specific units available at the specific price points being asked are mismatched with the financial capacity of the current demand pool. This is what I was pointing toward earlier when I described the affordability vacancy paradox. And Miami is simply the most visible current example of a dynamic that is operating in the luxury and upper mid-tier segments of multiple major American metros simultaneously. What this means for property values in the surrounding market, how the deterioration spreads from the luxury segment downward through the value chain, and what the specific indicators are that tell you whether your market is in the early stages of this process is exactly what we are breaking down in the final section. Along with the complete framework for protecting your equity position in whichever category of vacancy market you find yourself operating in right now. Everything we have covered in this breakdown converges on a single practical question. What do you actually do with this information? Because understanding that 16 million homes sit vacant across the United States, that Phoenix and Austin are carrying dangerous oversupply concentrations, that Detroit and Cleveland are locked in generational vacancy spirals, and that Miami's luxury market is accumulating affordability-driven vacancy at the top of its value chain. None of that analysis protects your equity or improves your investment positioning unless it translates into specific, actionable decisions. So let us build the framework. And let us build it in a way that applies whether you are an owner-occupant sitting on accumulated equity, a landlord managing a rental portfolio in one of the markets we have identified, or a prospective buyer trying to navigate entry into a market where vacancy dynamics are actively reshaping the risk profile of available inventory. The first element of the framework is what we are going to call the vacancy trajectory assessment. And this is fundamentally different from looking at current vacancy rates, which is what most homeowners and investors do when they bother to look at vacancy data at all. Current vacancy rates tell you where a market has been. Vacancy trajectory tells you where it is going. And in the current cycle, the gap between those two data points is wider than it has been at any point in the past decade. Here is why that gap exists and why it matters so much right now. Stop and consider the timeline of vacancy accumulation. The forces driving vacancy higher in the current cycle, oversupply delivery, short-term rental conversion, affordability-driven demand withdrawal, these forces do not produce their full effect immediately. A luxury apartment tower that delivers 300 units into a softening market does not register 300 vacant units on the day it opens. It registers a gradual increase in vacancy over 6 to 18 months as the initial lease-up period fails to hit underwriting projections and units that were supposed to be filled remain available. The vacancy rate today reflects the supply and demand dynamics of 6 to 12 months ago. The vacancy rate 12 months from now is already being determined by decisions and pipeline deliveries that are visible in the data today if you know where to look. This is what I was pointing toward at the very start of this breakdown when I said the markets most at risk are not the ones with the highest current vacancy rates, but the ones where the structural pressure driving vacancy higher is already locked in. The trajectory is the leading indicator. The current rate is the lagging one. Here is something most people completely overlook. The three data sources that give you the most accurate vacancy trajectory picture for any specific market are all publicly available and require no specialized access or institutional subscription to analyze. The first is building permit data from the Census Bureau. Permitted units that have not yet delivered represent future supply additions that will hit the market regardless of what demand conditions look like when they arrive. A market with a large permitted but undelivered pipeline is carrying forward vacancy risk that its current rate does not reflect. The second is short-term rental listing data from platforms like AirDNA, which tracks active short-term rental inventory at the zip code level. A market where active short-term rental listings have declined more than 20% from peak without a corresponding increase in long-term rental occupancy is showing you supply that has left one market without being absorbed by another. That unabsorbed supply is either sitting vacant or about to hit the long-term market in a way that will push vacancy higher. The third is utility connection data at the municipal level. Active utility connections are one of the most accurate proxies for genuine occupancy because they capture actual human habitation rather than legal ownership or lease status. A market where utility connections are flat or declining while housing unit counts are growing is accumulating real vacancy faster than any survey-based measurement is capturing. Now let us talk about what you do once you have assessed the vacancy trajectory of your specific market. The second element of the framework is the equity buffer calculation. And this is where the analysis becomes acutely personal regardless of which type of market you are in. Paper equity, the difference between your estimated property value and your outstanding mortgage balance, is not a liquid asset. This is a point that seems obvious when stated directly, but is consistently underweight by homeowners making financial decisions in the current cycle. Paper equity cannot be deployed to cover carrying costs during a period of income disruption. It cannot be used to absorb a temporary vacancy in a rental property. It cannot protect you from being forced into a transaction at an unfavorable point in the market cycle. Stop here because this distinction between paper equity and accessible equity is the single most important financial concept in this entire breakdown for owner-occupants and small landlords in affected markets. You might think your equity position is strong because your estimated home value significantly exceeds your mortgage balance. But the reality is that equity trapped in a property in a rising vacancy market is equity that is simultaneously shrinking in value and becoming harder to access. As vacancy-driven price pressure builds in a market, lenders tighten home equity lending criteria. The line of credit you could have drawn against your equity 6 months ago may not be available at the same terms today. And the equity you are counting on as a financial buffer may be smaller by the time you actually need it than it appears right now. The equity buffer calculation forces you to answer 3 specific questions honestly. How much of your current equity is accessible through existing credit facilities right now? Not in 3 months or 6 months, but today. How many months of total carrying costs, mortgage, insurance, taxes, maintenance, could you sustain from liquid and accessible resources if your primary income were disrupted? And what is the minimum property value decline in your specific market that would meaningfully impair your ability to refinance, access equity, or exit the property at a price that covers your outstanding obligations? If you cannot answer all 3 questions with specific numbers, you are carrying more risk than you realize in a market environment where vacancy-driven price pressure is closer to the surface than the headline data suggests. Here is something most people completely overlook. The homeowners who navigated the previous crash cycle with their financial positions intact were not primarily the ones in markets that avoided price declines entirely. They were the ones who had done this calculation before the decline began and had positioned their liquidity accordingly. They had accessible cash buffers. They had credit facilities established during periods of financial strength rather than under duress. And they had made honest assessments of their minimum acceptable exit price before the market tested it for them. The third element of the framework is the repositioning decision matrix. And this applies most directly to landlords and investors in markets where the vacancy trajectory assessment has identified meaningful forward risk. The repositioning decision is not binary. It is not simply hold or sell. It has at least 4 distinct options that carry different risk and return profiles depending on your specific market category, your debt structure, your liquidity position, and your investment timeline. The first option is active repositioning within the market. This means identifying the specific asset characteristics that are showing vacancy resistance in your market and moving your portfolio toward those characteristics. In oversupply metros, the vacancy-resistant assets are consistently smaller, more affordable units in well-located submarkets with strong employment proximity. The luxury oversupply is not spreading evenly down market. The affordable end of the rental spectrum in most oversupplied metros is actually showing stronger occupancy than the headline vacancy numbers suggest because the renter pool being priced out of homeownership is concentrated in the affordable segment. The second option is yield optimization ahead of value decline. If your trajectory assessment suggests that price pressure is building in your market but has not yet fully materialized in transaction data, the window to optimize your asset's income profile before that pressure arrives is open right now, but it is not open indefinitely. Rent adjustments, lease term restructuring, operational cost reduction, these are moves that improve your cash flow resilience and extend your viable holding period if you execute them before vacancy forces your hand rather than after. The third option is selective liquidation with capital redeployment. In markets where the vacancy trajectory assessment shows all 3 negative indicators simultaneously, the expected value calculation of holding versus selling begins to shift. This is not a recommendation to panic sell. It is a recognition that in specific market categories the cost of waiting for conditions to improve may exceed the transaction costs and capital gains implications of exiting and redeploying into a market with a more favorable trajectory. The fourth option is strategic inaction with enhanced monitoring. In markets where the vacancy trajectory is concerning but not yet at the critical threshold, and where your liquidity position and equity buffer are genuinely robust, doing nothing while actively monitoring the 3 leading indicators we identified is a legitimate and often optimal strategy. The worst repositioning decisions in any market cycle are the ones made in response to fear of a deterioration that ultimately does not materialize at the projected severity. Enhanced monitoring disciplines you to respond to actual data rather than anticipated data. Here is the convergence of everything this breakdown has established. 16 million vacant homes are not sitting inertly across the American landscape, waiting for market conditions to improve. They are active agents of price pressure in the specific markets where they are concentrated. The oversupply metros, the legacy vacancy cities, and the affordability vacancy markets are each experiencing that pressure through different mechanisms at different speeds. But the direction of travel in all three categories is the same: toward higher vacancy, toward more motivated sellers, and toward property value outcomes that the current headline stability of national average prices is systematically obscuring. The homeowners and investors who come through the current cycle with their equity intact and their financial position strengthened will not be the ones who were in the right markets by accident. They will be the ones who assessed their vacancy trajectory honestly, calculated their equity buffer specifically, and made their repositioning decisions based on forward-looking data rather than the comforting but increasingly unreliable signal of where prices have been. Vacant homes are quiet. They do not announce their presence or advertise their consequences. They accumulate gradually, neighborhood by neighborhood, zip code by zip code, until the concentration crosses the threshold where the deterioration becomes self-reinforcing and the damage to surrounding property values becomes impossible to ignore. By the time it is impossible to ignore, the optimal window for protecting your position has already closed. The 16 million empty homes sitting across America right now are not someone else's problem in someone else's market. For a significant and growing number of American homeowners and investors, they are the most important number in their personal financial picture, whether they know it yet or not.